You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by Purepoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit purepoint.ca to access in-depth market briefings, sector analysis, and the inaugural Behind the Curve report, understanding when and how the uranium market turns. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's August 4th, 2026, and this week on Uranium Spotlight, spot prices firm through the summer slowdown. Washington's annual uranium report card reveals record inventories, China keeps building and buying, and Cameco delivers a quarterly defined by discipline rather than drama. The spot market spent last week doing what it has done for most of the summer, moving quietly but with a firmer undertone. The spot price opened the week at $86.25 a pound U3O8 and closed at $86.45 a pound U3O8 after briefly touching $86.50 midweek. 11 transactions were confirmed, a respectable count for late July, though the monthly total told the real story. July saw 33 transactions for just over 2.8 million pounds, the lowest monthly volume of the year, with small 50,000-pound deals making up a third of the activity. The more interesting signals came from the term market, where the tone remained constructive even when the headlines are quiet. A U.S. utility made its selection on a request for up to 1.4 million pounds U3O8, while a non-U.S. utility is evaluating offers for roughly 500,000 pounds a year, covering 2027 through 2031. Several more utilities are working on requests for information with deliveries stretching into the early 2030s. At month end, the long-term price held at $94 a pound U3O8, comfortably above the spot, while the 3-year forward stands at $101 and the 5-year forward at $108. That structure matters more than any single week of trading. When the long-term price sits above spot and the forward curve slopes upward, the market is telling you that future pounds are worth more than pounds today, which is the opposite of a market expecting supply relief. For investors, the key takeaway is that the summer lull is a volume story, not a price story. Utilities are still quietly locked in supply years ahead, and the curve says that they expect to pay more, not less, as this decade unfolds. This past week, the U.S. Energy Information Administration released its annual marketing report for 2025. It paints a picture of American buyers paying more for less. U.S. reactor operators purchased 46.9 million pounds of U3O8 from suppliers last year, a 16% decrease from the 55.9 pounds they bought in 2024. At the same time, the weighted average price they paid rose 11%, from $52.71 to $58.46 a pound. Canada was once again the top source of U.S. deliveries, with 32% of supply coming from Saskatchewan and its Athabasca Basin. Kazakhstan followed at 28% and Australia at 15%, with Uzbekistan and Namibia accounting for 7% and 4% respectively. U.S. domestic production covered just 7% of requirements, down from 8% the year before. The headline number, however, is inventory. Total U.S. commercial inventories now sit at approximately 170 million pounds, the highest level since 2003. That is a stockpile that could take U.S. reactor operators at least 3 years to work through, and it suggests utilities are building a cushion ahead of what many foresee as a coming supply crunch. The hope is that sufficient stockpiles will let them weather the storm. The risk is that prices spike and stay high, leaving the United States at the end of this contracting cycle up the proverbial river without a paddle. The report also confirms where uranium actually trades. Spot purchases account for only 13% of deliveries at 2025, at a weighted average of $75.83 a pound, meaning 87% of material moved under long-term contracts at an average of $55.91 a pound. The long-term market is where the majority of uranium is bought, and that will not change. What has changed is the relationship between the two prices. For years, long-term prices sat below spot. As of 2026, that narrative is flipped, with the long-term price now above spot and forward indicators pointing above $100 a pound. Even if a 3-year stockpile carries the U.S. through the worst of the crunch, there's already been a massive wave of contracting across Asia and Europe this year as reactor operators rush to secure supply, with European stockpiles reportedly dwindling according to the latest Euratom Supply Agency report. Without meaningful domestic production, the U.S. will eventually have to return to international markets, and when it does, it will find a severe lack of supply waiting for it, driven by decreased demand elsewhere. For investors, the key takeaway is that America's record inventories are not a sign of comfort, but of preparation, and the buying that built them is now shifting demand pressure onto very markets the U.S. will one day need to re-enter. A new study has uncovered that China likely received undocumented imports of uranium from the Democratic Republic of Congo between 2000 and 2024. The material appears to be a byproduct of production at a mine in a region rich in cobalt, copper, and uranium, with the uranium likely recovered at the processing plant in China. Because the quantities fell below IAEA thresholds for annual reporting, its existence went largely unrecorded. Estimates of the total range from 4.4 million to 11 million pounds of U3O8 across the entire 24-year period. Whether the material went into reactor fuel or some other use remains unknown, but at the low end of that range it is relatively insignificant, a trickle rather than a stream. The more consequential news out of China is on the demand side. In a single day this past week, China both started electricity production at one reactor and connected another to the grid. On another single day, it announced and approved plans for 8 new reactors. Demand within the People's Republic is only going to grow, and China's stockpiles long ago surpassed those of the United States multiple times over. Between supply agreements and inventory, China likely holds more uranium than any other nation on Earth. That gives Beijing the best chance of weathering the coming supply crunch without passing price increases on to consumers. Western countries, which lack the same access to Kazakh, Central Asian, and Russian material, face a harder road, and without proper preparation, their reactor operators will feel it. The supply crunch is coming, and a trickle of previously unknown Congolese uranium will not make much difference. What might make a difference is whether the world can bring new greenfield uranium production online in the next few years. Without it, the nuclear renaissance itself might be in jeopardy. For investors, the key takeaway is that the marginal pound matters far more than the mystery pound. The story worth watching is not what China quietly imported over 2 decades, but whether the West can build the new mines this cycle requires. Cameco closed out the week with second quarter results that were lighter on headlines than a year ago, but consistent with the story the company's been telling all cycle. Net earnings came in at $25 million, with adjusted net earnings of $77 million and adjusted EBITDA of $391 million. The declines from 2025 were driven largely by Westinghouse, which a year earlier booked roughly $170 million US from the Dukovany reactor project in the Czech Republic. Spring flooding along northern Saskatchewan supply routes disrupted production during the quarter, but annual guidance is unchanged at 19.5 to 21.5 million pounds U3O8. The underlying uranium business continues to strengthen. Cameco's average realized price rose 18% to $67.79 a pound US, and the company holds contracts averaging more than 28 million pounds of annual deliveries over the next 5 years. It also closed the increase to its Cigar Lake ownership, deepening its position in Tier 1 assets in a politically stable jurisdiction. 2 other developments frame the quarter. Westinghouse, jointly owned by Cameco and Brookfield, has confidentially filed a draft registration statement for a proposed initial public offering, a move that could put a public valuation on Cameco's stake for the first time. And Kazatomprom, the world's largest producer, reported first-half production of 13,291 tons of uranium, up 9% year-on-year, with nearly all of it committed under long-term contracts rather than headed for the spot market. For investors, the key takeaway is that realized prices are climbing even while spot drifts sideways, which is exactly what contracting discipline is supposed to deliver. Watch the Westinghouse IPO closely because a strong public valuation would highlight value inside Cameco that the market has never priced directly.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by Purepoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit purepoint.ca. Join us again next Tuesday for another edition of Uranium Spotlight.